Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
Mr. Sandman.
You get the idea?
Bring me a dream.
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him 2 lips like
It's like no cheese I've ever tasted.
and tell him that his lonesome
Here's the
nights
Sandman.
are over, Sandman.
You've worked hard the last 20 or 30 years at it. You're now finally making some profits and able to stick some money away, and then you get the call. What am I talking about? Your small business. Is now the time to sell it? Cash out? Selling your business could be one of the most important decisions of your life. And if you're thinking of selling your business, then you need an exit strategy so you don't make a huge mistake. Clear your schedule for the next hour as I walk you through things you need to consider before you put your business up for sale. Good morning. I am David Hollander, and I am your host. I am the Sandman. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman, and that's because I help my listeners sleep well at night by answering their most troubled tax, legal, and financial questions each week. So if you own a business and you're thinking about what the next chapter might look like for you, you know, life after owning your business, then you'll definitely want to listen to today's show. As I'm going to put out there, this show is all about removing uncertainty. You've had your head down the last 10, 20, maybe even 30 years building your business. You've taken the risk, leveraged your assets when times were tough to keep your people employed, and now you're finally making a profit. A private equity person or a competitor just contacted you and wants to buy your business. Well, how do you prepare for something like that? What steps do you need to take right now before you start the conversation? Or if you're in a conversation right now, what do you need to know before you close the deal? Listen, if you're feeling fearful, if you're feeling unclear, anxious about your future, it's because you don't have a crystal clear path for each step. Yes, I'm talking about before and most importantly, after the sale. Now, let's get started. Well, finally, we had a decent week on Wall Street. Stocks rallied sharply this past week as economic data and Fed commentary spurred a decline in interest rates. It's been forever, hasn't it? Well, anyway, the markets all liked it. The Dow had a pretty good week, up 5.1% for the week. S&P 500 almost up 6%. NASDAQ up over 6.6%, and the MSCI EAFE index up 3.1%. So, wow, what a difference a week makes, right? The 10-year Treasury pretty flat, down about 0.3%, closing, importantly, at 4.52%. Remember, we were talking over 5% last week, so we had a pretty big move. I mean, think about it, it's a pretty big move in just a week as rates came down, market went up. Also, the price of oil came down this past week, too, down 5.4% to close at $80.92 a barrel. So that was, an interesting week, and we were sort of ready for this sort of thing to happen. After all, when you look at what the Fed said, it was pretty good for the markets overall. They basically said that they're done. Of course, they left the door open for further raising if the data showed it. But overall, we looked at the labor market and so forth this week. Numbers are pretty good. So the market really liked it, and of course, that rewarded well. So the question becomes, well, now that we're sitting here in November, got a couple more months to go, what does the market look like overall? Well, remember, this is the season. When you go to Starbucks and they start making those fancy drinks with the pumpkin or whatever, spice lattes and all that business. Yep, November is here, and you got the Thanksgiving holiday coming up, and then Christmas and so forth. So since 1980, the last 2 months of the year, specifically November and December, have looked pretty good overall. In fact, the last 2 months of the year on average since 1980 has been up 79% of the time. 79% of the time. How much do you ask? Well, the average has been about 3.5%. Of course, there's been some years there where we've had down years like 22 and 2018, but on average, it's been pretty strong. And so, the question becomes, well, is there any sort of correction out there? And, of course, there's no guarantee in the market that you're not going to have a pullback here or there. But it looks like the one we just had, this little brief correction, we'll call it. Because remember last week we were talking about a correction, which is typically when a market drops down over 10%, which we had. And these sort of 10% pullbacks, they're healthy. But when you look at that situation where you had a correction, and then you look at how markets do after their correction. Now, I went back to April of 2010 to take a look at this. And so when you looked at April of 2010 through July of 10, we had a pullback of around 16%. And what ended up happening 2 months thereafter, the market was up about 7%. And if you looked at it a year later, it was up 33.6%. Now, we went ahead and did that through 2011, 12, 15, 16, 18, through 23, which is the question mark right now. But overall, the next couple of months looked pretty good. The low was up 1.3%. The high was up 19.2%. Again, that was in the 2-month period. And the 1 year following, the low was 7%. This was back in February of 18. And the high was December of 18, up 39.9% on the 1 year following the correction. Now, I mean, again, you can't really roll the dice on this sort of thing because it is what it is, but make sure your investment strategy is what you need it to be. Make sure you got the income you need to see. Now, that was also spurred this week by the employment numbers that we just saw on Friday, and that employment report really did support what the Fed was talking about on Wednesday, in that the numbers came in cooler than what was expected. Now, remember, we were seeing, jobs over 250,000 as an average, and so when we saw this 150,000 number, that was pretty widely accepted and approved by the market, and that's why we had this further rally on Friday in the market to see the week finish strong. So overall, employment looks pretty good, looks still healthy. The market and the economy think so. So things look decent. Now, you're probably going to ask me, well, what is the S&P limits on the upside and the downside we should be paying attention to? If you look at technical analysis, that is, which periodically we like to do. So remember, we were talking about the S&P 500 and where it would close. And Wednesday, after the Fed meeting, the S&P 500 closed at the 4225 mark, which was a pretty, supportive level. And so that's going to be your new support on the downside, that 4225 level. Now, we also saw, remember the VIX index, I did a whole commentary on that a few weeks back. If you missed it, go back and listen to what the VIX is all about. Simply, it measures volatility in relation to the options and hedging activity that's out there. So as a result of Wednesday, the VIX was down in a day 7%. I mean, think about that, down 7% in one day, which indicates that there is a clear easing in volatility and expectations of what the future, or at least the immediate future, could look like in terms of hedging activity. So that was good. And so when you look at where the upside should be, next stop, if we break through it, and then further upside on the S&P, I'm going to call that at 4380 right now. So if you recall, we closed on Friday at 4358 on the S&P 500. 4380 would be the resistance that would have to break through and close at with volume to see that move higher. And again, that's just based on data that we're seeing. So overall, things continue to look decent. I don't expect, I said this last week, I don't expect any material breakdown here, any sort of black swan event. And when we talked about that Wall Street Journal article last week, and what it was comparing to money supplies and markets and where things were going, and is this the beginning of the end? And I said last week, I don't think so, and I still don't. I still think that overall this data we saw this week, when it came to several of the things that we looked at, including labor and production, it's just about right. It's almost the Goldilocks scenario. The porridge is just the right temperature. It tastes perfect, and you eat it, and it's all good, and it's not too hot or too cold. it's about where we are right now, and it's just continuing to unfold that way. So, overall things are going pretty well, and really not that much for you to be concerned about at this point. Okay? All right. Are you considering selling your privately owned business? Well, if you are, I've recently completed a new book that I've written, and so I'll be talking about that, some specific steps you should consider taking right now before you enter into that letter of intent regarding the sale. You are listening to the Protect Your Assets show with David Hollander, the Sandman. That's me. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And if you own a business, then you'll definitely want to stay with us for the entire show today, because we will be sharing how business owners can prepare for retirement before they sell their privately owned business. And right before I jump into that, let's talk about some new changes from the IRS and the Social Security Department. We've got Social Security benefits are going to increase in 2024 by 3.2%. The increase will take effect in January of 24. And when will you receive your notice about this? Well, they're saying that the entire month of December, notices from the SSA will be mailed to you. If you don't get your notice, then you can always check it online by checking out your own Social Security account, and that can be reached at ssa.gov. Also, some other announcements. The IRS increased the amount that you can now save in 2024 when it comes to your 401k, 403b, and 457 plans. That amount is going up to $23,000 per individual, and if you are over 50, you get a $7,500 catch-up in addition to that. So you can, starting in 24, put away $30,500 a year. Now, the IRS also updated the amounts you can contribute to an IRA or a Roth IRA if you qualify in 2024, and that amount is now $7,000 per individual. And you can do a Roth contribution because they increase the individual income amount up to $161,000. Now, if you make more than $161,000, there are still things you can do to do what's called a Roth conversion. And so if you would like to know more about Roths, give us a call, 866-PROTECT. We're more than happy to help you with that. Also, Social Security increased the max earnings rate in 24 to $168,600. So everything up to $168,600 will be taxed and put away as part of your Social Security benefit. All right, so let's switch back to today's topic. We're talking about selling your business. If you're looking for the right exit strategy now at the right price, even though the market and the economy somewhat is a little uncertain at the moment, then you're in the right place. So the first thing you need to do is you have to start with understanding, what is your business worth? Often the business is your largest asset, and the decision to sell this asset could have some very big financial ramifications after it's all said and done. Just waking up one day and wanting to sell your business at a moment's notice would probably be the biggest mistake you could ever make. I recommend that you have a plan to sell your business in place that was constructed by a business attorney, a tax and financial professional, all acting together as a team to help you put something together. And it starts out with finding out, what is your business worth? Most service industries typically sell for around 2 to 3 times the gross earnings. Other businesses could sell for more or less than that. Just really depends on what you're doing. But we need to find out what your business is worth before you start this process of preparing to sell it. So once the decision has been made to sell your business, the first thing that we usually do, and we can help you do this, is cleaning up your books. So I recommend that you separate, first of all, the business expenses from the company's P&L. Like what? Well, your cell phone. Is your cell phone and all your family's cell phone running through your business right now, or your car? Those are the most common ones that we see, and those could be taken off of the P&L and stuck on your, of course, direct pay as a way to reduce overall expenses to the corporation. With those costs removed, your gross income should increase and not only get you a higher price, but also allow potential buyers to get a better picture of what your company's finances really look like. And this will help you get a better idea of what your expenses would probably be like in retirement if you kept the same phone and kept the same car. Next, consider having the business finances audited. Now, I really recommend this, particularly if you're doing the books yourself or you have someone doing your books who you're not 100% confident in, because what will happen is these outside folks, when they come in and review your financials, are going to be very critical about them, and they're going to be looking at everything. And so that's why an audit by an outside firm who does those sorts of things, an accounting firm that specializes in that, could really help you not only boost your confidence in terms of what your company's performance is like, but will really help a lot when that buyer is kicking the tires and asking you a lot of the tough questions that the auditor has vetted. The accounting firm you hire should be able to produce quality reports that any buyer that's going to know what they're doing is going to ask for, and they should be able to turn those around pretty quickly. Although not a full audit, it validates the company's reported earnings and identifies those one-time business expenses or some improvements maybe you did or other adjustments to show that your business could be more profitable if those things weren't part of last year's financials or the year before that. This also gives you an expert to help you refute any concerns that the buyer could raise during their due diligence, which will be an intense process. Selling a business can take anywhere from 2 months to 5 years. And if you start this process early, it gives you a lot of time, hopefully, to adjust, which should lead to a better overall sales price. Make sure that you have employee confidentiality agreements, vendor contracts, and all of this organized in an electronic format that's easily accessible and transferable in a safe environment so the data is not lost or possibly stolen. Having the right insurance to protect the personal assets of the director and officers in a lawsuit is also important, particularly if you don't have any suits out there, but one could be coming. That also can derail plans of an easy sale. We also recommend that you think about this like if you were going to sell your house. To get more money from your house, you probably would spruce up the bathrooms. You would change the paint colors to, of course, the white neutrals that everybody's after today. You'd take out the old flooring and replace it with something clean and fresh, right, and get rid of some of the old furniture. It's a very similar process when it comes to your business. Sure, it's comfortable. Sure, it's something you've gotten used to and you enjoy it. Otherwise, you wouldn't be doing it, and it does reflect you. But let's face it, someone coming in who's really just trying to make money at the end of the day probably is not going to like the way you do some things. So you're going to have to clean those up and make them look a little better before you put it out there. Now ask yourself this question: do you have the time to get all this in order? Well, I recommend getting all this in order before you sell, as that can get you money for what you work so hard to build. Then once you sell, how do you convert that chunk of change into income that pays you every month until you're no longer here? And also leave a legacy for your family instead of passing most of that money on to the government. Well, I certainly get it because we deal with these kinds of situations regularly. On my team, we have a corporate attorney who has over 30 years of M&A experience working for a large law firm. He now works with us. And we also have a team of accountants and financial planners who can map all of this out before you sell your business. And this is important because when we've looked at other deals and other people getting involved in this, typically the financial plan after the sale is never even discussed or described or thought about until you've already put the practice. And I would say to you, that's not a good way to go. Because if you're a private business owner and you're thinking of selling, then the first thing that you should be doing right now is to pick up the phone and give us a call. What I will do is I have just written a new book. It's called The Entrepreneur's Exit Strategy. And right now we are getting it ready to go, and you will get a copy right now absolutely complimentary. And this book walks you through this process, but you need to call us right now to get in line to get that. So give us a call if you'd like a copy of The Entrepreneur's Exit Strategy. 1-866-PROTECT. Again, get your copy. Call 866-776-8328. Again, to get a free copy of The Entrepreneur's Exit, call 866-776-8328. Coming up next, it is time for our popular They Say segment, where we will share how to price your business. Even if you don't intend on selling the company, you should have a good idea of what it's worth, because that's going to be part of your estate. And of course, that will be taxable. And then what we'll be talking about after that is how are taxes factored in to the sale of the business or the inheritance of the business, and how do you think about taxes when it comes to your retirement plans if you have a closely held corporation. So much more useful information is coming your way, certainly if you're a business owner. You don't want to miss any of this. Stay with us. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Hey, welcome back. I'm David Hollander, also known as the Sandman, and you are listening this morning to Protect Your Assets. And if you own a business and you're thinking about what the next chapter might look like for you, you know, life after owning your business, then you'll definitely want to stay with us for the entire show today, because we are sharing how business owners can prepare for retirement before they sell their privately owned business. And that reminds me, right now we've got just a little bit of time left for 2023. Now it's time for one of our fan favorite parts of the show, our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All I know is that I don't know.
All right, so here's one they say. They say that your business should be priced based on the income it earns. Well, is that all there is to it? Well, realize that people use different methods to price your company. So I'm going to say, no, that's not true. In some cases, certainly revenue has something to do with it. But we were just involved in a transaction recently where the income really wasn't that great because it was a newer business. And this was kind of interesting. They had these assets in the business that were worth more money than they were when they bought them. And they had several hundred of these things. So because of the pandemic and because of this particular market, these items were not produced in a way where you could just get them readily. And so they became quite valuable, and we ended up valuing the business based on the assets that were in the business. But let's talk about sort of the traditional ways these things go about, because, of course, maybe you fall into a different segment. One way is to compare the value of, say, a publicly traded company that is similar to your privately held business. And that could give you an estimate of what your business could be worth based on, say, what that publicly traded company is trading at when it comes to the price to earning multiple of what the company's earning. Now, of course, typically publicly traded companies may be a lot larger than yours, may have a lot more revenue, but again, the numbers are still the same. You can still look at the price compared to the earnings of the company and what is that stock trading for. Usually we see technology companies trading for a lot more then the earnings justify. Sometimes they don't even have any earnings. They're negative cash flow. So it really just depends on the type of business. Another way to do this is look at acquisitions of similar companies with publicly disclosed prices on the sale. I was quite surprised last night. I was looking through some of those. This information is out there. You can find it. You can see what certain things traded for. Sometimes that is private and it's not disclosed, but a lot of times it is public and you can find out. And so if you know of a competitor or someone else in the area or even different part of the country, but a similar business model, similar client base, similar trend in growth and operations and income, you can get a decent handle on what that value could look like. So that's another way to do it, by looking at publicly disclosed trading prices. A third method is what they call a discounted cash flow analysis. Now, this forecasts the value of the acquisition based on future cash flow. And what that means usually is the longer you've been in business, or the more desirable the product or service that you're delivering, could create a more predictable future cash flow as a result of what you've spent all this time building. Think about Facebook as an example. Remember, they didn't do so much for so long, but they had these massive client bases that they were eventually going to be able to market to. And now you can see what sort of cash flow and income they've been able to generate. And of course, the price of the stock. The better job you've done that, the better the future cash flow could be. Obviously, the higher the price you should get when you go to sell it. And like I was discussing earlier, buyers generally base what they're willing to pay on a multiple of the earnings before interest, taxes, depreciation, and amortization. You're going to hear this phrase a lot when you start to get into this conversation with whoever is acquiring you. It's called EBITDA, E-B-I-T-D-A. It is earnings before interest, taxes, depreciation, and amortization. So make sure you get familiar with that concept, what that means. If you're a business owner, you probably do. But if you don't, it's okay. It's an education. In my book, I talk a lot about it, so you can read it there in the book. And it really gets down to fundamentals. Good, strong fundamentals, loyal customers, better margins. If you have that type of business, you're going to get a higher multiple. It's just that simple. And the sale of your business could have some very hefty tax implications for you. So it's a good idea to start to think about that. Now, how could you do that? Well, a lot of small businesses that we see, they organize typically through a pass-through entity. That could be an S corporation. It could be an LLC. And the way that works, as you know, if you own one of these, is you flow through that income after expenses to your personal tax return, and then you pay taxes on your individual tax rate based on that income. Now, if you're a C corporation, or if you're thinking about setting up a C corporation, realize that there are some disadvantages to that, because you're going to pay taxes at the corporate level, and then when you pass those on to your shareholder level, you're going to pay taxes again at that level. Now, it may not be too late to change that prior to thinking about selling as well, as long as we have some time to work through all those things. So the proceeds from a sale of a pass-through entity like an S or an LLC, again, will only be taxed once when the owners pay their personal income tax rates. Rather than if you had a C corporation, once again, you could be looking at twice the tax, because remember, you're going to pay tax at the corporate level and again at the shareholders' personal income tax rate on the shares of the proceeds. So depending on the transaction structure, that can make pass-through entities more advantageous for some business owners, but in general, you may want to structure the deal so that more of the proceeds are taxed as long-term capital gains. And remember, those long-term capital gains rates right now are at, on the federal level, are at 20%. That rate will change when the tax law changes in about a year and a half from now. So if the proceeds are taxed as ordinary income, remember that federal tax could be as high as 37% right now, and also California is going to take their bite on that as well. you want to think about all this because rates are going to go up in 2025 when the current law sunsets. And right now, it looks like you're going to pay more taxes if you wait to sell your business, say in 25, 26, or 27. So I would encourage you to get in front of this now, particularly if you're thinking about selling your business in the next couple of years, because you can negotiate the way that you receive that payout. In other words, the form of the payout could vary depending on your needs and what you're trying to do. For instance, you could ask for an all-cash offer. That would put very little risk on you, enable you to take advantage of some of the current tax laws. And if a private equity firm is the buyer, they're going to most likely want to give you some cash up front, but also give you equity in their company. Now, I would encourage you to really think about that, because if you start to take equity in their company, whatever that percentage is, that's going to put more risk on you, because your future is going to depend on how that company performs and how viable they are as the economic activity unfolds over the next few years, which I personally think that at some point in the future we're going to be having some sort of a mild recession. And if we do enter some tough times and things get worse and interest rates don't go down as much as everyone thinks, we could be in for some pain. So, you know, these companies that are used to levering up and trying to make things work, well, they may not. And in that case, now you're stuck with equity that's not worth anything, and that could be a problem. So you don't have to work also with the law firm that the buyer might be recommending you to use in the transaction. And I would recommend that you think about that as well, because attorney's fees on these types of transactions, particularly if you're looking at a business that's, say, valued at $30 million or more, attorney's fees can be over $800,000. You can work with your own attorney who is really your fiduciary, your expert, looking out for your interests. And so I'd recommend you spend those dollars, which will come out of your pocket anyways, on a lawyer who's on your team. And like I was talking about in the previous break, we have experience in these types of deals. We have a corporate M&A lawyer on our staff who can help you with the full package, not just making the deal happen, but also looking out for you and making sure you're taking advantage of some of these opportunities and making sure you're not getting burned on these other things that we're talking about. If you want to find out more about this, call me right now and get a second opinion before you sign the dotted lines. Complimentary, and we do all the heavy lifting for you. So give me a call right now and find out what's possible. Call this number, 866-776-8328. You can remove the gray area, get your questions answered, maybe even get a question answered that you're not getting answers to right now, but you have to take action. So call us, 866-776-8328, and find out what you don't know. Again, 866-PROTECT. Moving on will be a lot easier if you know how you'll spend your time after you sell the company. Those answers will be coming up next. It always pays you to keep it tuned right here to protect your assets. We'll be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com, where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And that reminds me, if you missed any of today's show, and particularly the market segment that we started with, the top of the market, where's the market going? Well, you can find out by listening to our podcast. Wherever you get your podcasts, just type in Protect Your Assets, and then you can add to that the market segment, and that's where you will find some great information. Now, if you did miss any of today's show as well, we do the podcast of the show in addition to the market segment, and you'll see the title of the different shows. Today we've been talking about what if you wanted to sell your privately held business? What are some things that you need to think about, and so we've been covering a lot of that today. And if you're just joining us right now and you own your own business, well, selling it could be one of the biggest decisions of your life. And today we've been covering how business owners can prepare for their retirement before they sell their privately held business. And that reminds me, I did recently write a book. Yes, a new book. It's called The Entrepreneur's Exit Strategy. And so we are taking orders right now before it comes out. And you can get a copy for yourself. This morning I've been offering it out there just by giving us a call, 866-PROTECT. They will get some information from you. Again, The Entrepreneur's Exit Strategy. If you own a business, you're thinking about it, get a copy of this book and see what you don't already know. Now, getting a big chunk of money can change your life in so many ways. I've seen this happen with athletes, with lottery winners, and if you own a business, it could happen to you in that all of a sudden you're going to get a very large chunk of money, and your business will, of course, go away. Most people think it makes your life so much easier. Well, it doesn't. So many times I've seen this, more than you would think, where that's just not the case. Many of our clients come from humble beginnings that didn't include fame or fortune or big chunks of money. And selling a business can be like a grieving process in a lot of ways, because a lot of our clients have built their business up with their time, their energy, their sweat, their tears, their anxiety, putting pressure on their families just to get to a certain place, because, of course, your family's usually supportive of what you're trying to do, and it's not easy to let go. But moving on may be a lot easier if you know how you'll fill your time and spend that money that you will be receiving when you sell it. So some of my clients wait a few years before they possibly start another business. Some of our clients continue to work for the company that they're selling. They shift from the CEO usually to an employee, of course, one with a lot of guidance and help. Or they might become an independent consultant where they get a 1099 for a period of time after the sale of the business is final. Now, if that's your plan, then I recommend you work those details out in writing during your negotiations, so when the deal is done, you're getting most of what you expect to happen. Because keep in mind, it's going to be hard to watch somebody else make those decisions about your company, about your employees, after all that time that you've put into it. And so I recommend writing down, you could even do it right now, what you see yourself doing over the next couple of years as this unfolds. Owning and running a business identifies you, and this could help you help others, which doesn't necessarily have to mean you're compensated financially for it. Sometimes doing things pro bono gives you a different kind of satisfaction, and many of our clients really have enjoyed that. So I highly recommend you map out a strategy to maximize the amount you could get if you do sell your business, and then take that amount after tax, simulate your lifestyle. What would it look like? Where will you live? What will you be doing and why? Where will the income be coming from month after month after month? It really is very important, because I see this all the time. If you haven't thought about it, thought about where you're going to invest it and what that income is going to produce and what it can look like, you may think, well, it makes sense to buy real estate. Not necessarily. You can see in San Francisco, there was a building that was worth $300 million that just traded for $60 million because of what's going on in San Francisco right now. Real estate may not be the ultimate way to go. Sure, it could be part of it, but are you experienced in real estate? Do you know how to manage real estate? Do you know what the cash flow should look like after taxes? You know, there's a lot to consider. So don't just think that doing one thing or another thing just makes all the sense in the world. It might not. And so you need to, today particularly, have the ability to simulate what things can happen and what that would mean to you month after month after month. Because after all, you have to create that income for yourself and maintain that lifestyle that you're looking forward to. So for anyone nearing retirement and thinking about these types of complicated, complex decisions, I highly recommend you get with a team who knows how to work through these things. We have attorneys, CPAs, and financial advisors on our staff who map all this out, and we help you make these decisions before you have to. Now, do yourself a favor. Inhale through your nose. Exhale through your mouth. That's it. Picture a day when you don't have to worry about who's going to take care of your clients anymore. Picture a day when you're sitting on a deck of a large luxury liner. Your family is celebrating with you your success. Picture a day when you can relax, travel, and do all the things you've always wanted to do. Give us a call right now. Call 866-PROTECT. We are fiduciaries. 866-PROTECT. Pick up the phone and talk to my team right now. 866-PROTECT. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. My executive producer and network manager, Kevin Renfer. And, of course, all my fabulous producers back there, Phil, Adrian, Lucas, because without my team, I'm just another pretty voice on the radio. Thanks again, everybody. You have been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.